right, let's just go ahead and get this going. Again, my name is John Weekly, and I am the Senior Mortgage Loan Officer here at Kelly Community. I've been here, this will be my 6th year at the credit union doing mortgages for them. And I'm also joined by our mortgage department supervisor, Audrey Airy. She'll be on standby answering questions as we go. This is going to be a 2-part educational seminar this evening. So in between parts, we'll probably take a brief pause to answer any questions that may not have been answered by chat throughout the process. So with that, we'll go ahead and get started with our Home Buying 101, the path to home ownership. Let's see if I can make this work. There we go. All right. So our objectives for this seminar is to more prepare you as to what to expect in the home buying process, both in the lending side and then the home buying process itself. So we're going to go through the first part, which is more what the lenders are looking at, what they evaluate, such as the 4 C's, character, capacity, capital, and collateral. And this information is good for you as the borrower or consumer to pre-qualify yourself before you come to a lender. That way you know what to expect when you're going through the process, and so there's nothing that'll surprise you once you get to the lender themselves. And then the second half, we're going to go through the home buying process, reviewing your first steps, understanding what costs are involved, which will also touch on that in the first part, the types of mortgage loans, the decisions that you'll be faced with, knowing what to expect at the closing process, and understanding the process itself and the related cost. So let's talk about the 4 C's of credit worthiness. So the first one is character, which that's the measurement of the applicant's payment reliability. The second is capacity, your ongoing financial means to repay debt. The third is capital, funds for down payment and closing costs. And the last is the collateral, which is the house itself, and that protects the lender if you fail to repay the loan. So let's go over character and dive in a little bit on that one. Character is, it's your credit. It's what we look at to see how you pay your existing obligations. So things we look for, kind of like in this picture, if you've had any repossessions, if you have any judgments, what type of collection accounts. And we also look at the good payment history, making sure there's no 30-day lates. There's no high debts on credit cards or just high debt in general. We pull your credit from the big 3 credit reporting agencies, which are going to be Equifax, Experian, and TransUnion, and that's their information. So if there's anything that you need to find out on your credit report or even dispute, you can go directly through them. And there's other avenues that we'll talk about if you have to dispute anything on your credit. But as a mortgage lender, we are going to pull all 3 credit bureaus, and we're going to go by the middle score. So if there's multiple borrowers on a single loan, we're going to use each of your middle scores, and typically a mortgage lender is going to use whoever has the lowest middle score. Us here at the credit union, for our own portfolio stuff, we can average those 2 scores, which will help with an interest rate. So that's something kind of unique that we do that not many lenders, if any lenders, do at all. So one of the most important financial documents about yourself is your credit report, which is a record of your bill paying history. So what is in a credit, what's in a credit report? Your credit report shows your bill paying history, which is what we look at to determine your likeliness to repay your debt. How long does information stay on your credit report? 7 years, unless it's like a judgment or something like that. Judgments can stay on there as long as it needs to, unless it gets paid off or dismissed. Who wants to see your credit report? As it pertains to the loan itself, your lender's going to want to see your credit report, as well as your homeowner's insurance company, because your homeowner's insurance rate and premium is going to be determined partly by your credit score. And then in general, some employers are requiring to pull your credit before you get hired. So that's also another reason why you want to keep up with your credit and keep it in good standing. So how do you get your credit report? We recommend that you go to annualcreditreport.com. You can pull one free credit report per year from each bureau. It's not going to give you your credit score, but it is going to show you everything that's on your credit, from current stuff to derogatory items such as collections or past due stuff, as well as closed items. And I always recommend you do this step prior to talking with a lender as part of the pre-qualifying yourself thing. So you'll know what's on there, what you need to clean up prior to getting to your lender, so you don't find that stuff out with a hard inquiry whenever your lender pulls your credit. So what if there's an error on your credit report? At that point, you can dispute directly from the Bureau's website. So it should show, of course, if you're doing an annual credit report and you're pulling per bureau, you'll know which bureau it's reporting to. But say if you go to a lender prior to pulling your own credit, your lender should be able to tell you what bureaus, it could be one, it could be two, it could be all three, that a collection account could be reporting to. And you'll need to go to each bureau that it's reporting to in order to dispute it. So your credit score. What is a credit score? Essentially, it's a three-digit number that we use as a lender to measure your credit worthiness, or how likely you are to repay the loan. What's a good score? At least a 680. That'll pretty much have most of your lending options available to you. Of course, the higher the score, the better. And why should you care about that? Because consumers with lower credit scores often pay much higher interest rates on mortgage, credit cards, and things of that nature because they're considered higher risk. And a FICO score ranges anywhere from 300 to about 850. And if possible, you want yours to be about 740. That will get you the best interest rates out there on whatever loan product you decide. Like I said, 680 is the minimum I would recommend that you would want to be at. Ideally, 740 is where you want to be. Okay, and how do you get your credit score? There's several free credit monitoring services out there. Credit Karma comes to mind as probably the most popular. It'll show you 2 of the 3 bureaus, their scores. It's not to be relied on as a true score, because they are using what they call a scoring model. So they may factor some things in that your lender, or they may not factor some things in, rather, that your lender's scoring model does. So the scores are going to be different than if you went to a lender to go pull your credit. But it does at least tell you kind of the path that you're on, if kind of a score range as to where you are. And if you're working on your credit, it'll update you every week to say if your score went up or down. Another one that I've seen is CreditWise. Most of your credit card companies will also monitor at least one of the bureaus. And then what affects your credit score? So payment history is going to account for 35% of your score. You'll always want to pay your bill on time. And from a lender standpoint, that means pay it before the 30 days is up. If you hit that 15-day mark and you get a late fee, that doesn't go against your credit, but going past 30 days will definitely affect it. Amounts owed to creditors accounts for 30%. How much credit do you have out there? Do you owe a lot of money to a lot of people? One of the big things that I see on this one is credit cards. Even if you don't have a ton of credit card debt, but say your limit's at $5,000 and you've got $4,500 charged on that credit card, just because it's getting close to the limit, that will negatively affect your credit score, even though it's not maxed out. So a good rule of thumb on credit cards is you'll want to keep that balance at least 30% or lower of that credit limit. And that's going to be your maximum credit score building range. So avoid maxing out credit cards or even getting them close to the limits. The length of the history accounts for 15%. So how established is your credit? A lot of lenders want to see at least a good full 1 to 2 years of credit history. Anything less than that, you might be limited on loan options. New credit accounts for 10%. When we pull your credit, we can see on your credit report the date that credit has been opened. So you want to, especially in the home buying process, you want to avoid adding any new debts or getting your credit pulled, because that could also potentially knock you out of getting a loan. And then the last one is the types of credit currently in use, accounts for the last 10%. Do you have a healthy mix of credit? And when I say healthy mix, what I'm talking about is a credit card, which is revolving debt, a personal loan, or a car loan, which would be an installment loan. Kind of diversify your credit types to show that you can pay both a termed credit like a car loan, you have a specific amount of time, and also revolving, showing that you're responsible with a revolving debt, that just because you pay it off, you can go charge more, just keeping that going. Okay, our next C is going to be capacity, which assesses the borrower's ability to repay a mortgage plus other monthly obligations. So how much can you afford? So whenever you're self-qualifying prior to going to your lender, here's a couple of things that you'll want to keep in mind whenever you're self-qualifying. Your housing expense ratio, keep that between 28 and 29% or less of your monthly gross income, and that's pertaining to the mortgage payments itself, the principal, interest, taxes, and insurance. And if there's a homeowners association, we do count that also into your housing ratio as well as your debt to income ratio. And then on debt to income ratio, you want to keep your debt below 43% if possible of your gross monthly income. A lot of the lenders out there, we can get 45 to 50% debt to income. Doesn't mean that is the best idea for you as the buyer, because there's other things that you're going to have to take in consideration when it comes to debt to income, because it only counts things that are financed, such as house, car, credit card, student loans. Even if student loans are in deferment, we still have to count a payment of 1% of the balance, because at some point during that mortgage, that student loan payment is going to become due, so that's why we have to count it. If you pay alimony, child support, and installment payments, those go against your debt to income. What doesn't go against your income, debt to income, is going to be things like a cell phone bill, utilities, and things like that, because they're not financed. So those are things that you need to factor in for yourself and keep in mind when you're looking at your monthly payment. Just because it's at 43% or less, or 50% or less, doesn't mean that there's not still other bills out there. And that's of gross income, not net. So just things to keep in mind there. Okay, and these are things we look at when it pertains to income. The history, do you have a history of earning income? Because it's a lot of times, if it's less than 2 years, it's hard to get some of those programs. Conventional typically is pretty good about, you don't have to have a 2-year work history in order to qualify, but you do have to have some history for sure. Consistent, has your income been consistent and stable over the past 2 years? Ongoing, will you continue to receive the same income in the future? And these are some sources of income that we look at. So non-variable are things like your base pay, your salary, a pension income if you're retired, Social Security. Those are the 3 most common that we deal with: family and employment, long-term disability, alimony, but we'll have to see that that's going to continue for 3 years, along with child support. That has to continue for at least 3 years before we'll be able to count that income. Variable income is going to be commission, bonus, self-employed. Those are probably the 3 most common, along with overtime. So those have to continue for at least 2 years before we can count that. So if you're in a sales position where you're commission only, or even if you get a base plus commission, if it's been less than 2 years, we can only count your base income, not your commission. And then if you're commission only, then unfortunately, it's one of those things that you have to be in that for 2 years in order to count it. All right. Hopefully you are not asleep yet. I know this is not not the most entertaining. I try my best, but there's just a lot of information to go through. Once we get through this part, it gets a little livelier. Income documentation. This is what income documents we require as it pertains to you. We'll need at least 2 years of W-2s, 30 days of most recent paycheck stubs, third-party verification or verification of employment. If you receive child support or alimony, court documents showing that you do receive that and that will continue for 3 years. If you receive Social Security, we'll just need your award letter that's given out at the first of every year, or the 1099 showing what you made over the previous year, or a bank statement showing direct deposit. Then pension and annuity and self-employment. Self-employment has to have 2 years tax returns. We can't do 1099s, and the reason is when you're self-employed, you write off certain things, and which lowers your adjusted gross income, what you pay taxes on, which is the number that a lender's going to use, not your gross receipt, but the adjusted after all the write-offs. Okay, and our third C is going to be capital, which is the money needed for down payment and closing costs and reserves if they're required. So this is just some information that we pulled up, and there's a lot of information on there. But it pertains to saving a down payment for 5%, 10%, 20% at different ages. So calculated is how much you'll need to save per month to put down on a payment on a typical home by age 35. Given various starting points, the calculation assumes a 5% rate of return on investment and a price of $275,000, which is the median home price in the U.S. as of February of 2019. So here's how much you'll need to save. If you start saving at age 20, for 5% down, you'll just need to save $51.23 a month. For 10% down, $102.88 a month. 20% down, $205.77 a month, which is not bad if you're starting early. By age 35, you can put that down on a house, and then it has the same for ages 25 and age 30, which at age 30 you only have 5 years left, so you really have to put some money back. Since these figures only cover the down payment, it's likely that you'll need a bit more to account for closing costs, insurance, and other fees. Home prices vary too, and it's possible that the median price will rise in the next 5 to 10 to 15 years, which we have seen that in the last 2 years. So it is very possible, but then again, we could be at the kind of the peak of that at this point. On the plus side, you may not be alone. 57% of all American first-time buyers plan to buy with a spouse or a partner, according to Bank of America's Home Buying Insight Report. Regardless, the bottom line is that if you start saving early, you'll have to put away far less each month, and you'll give your savings more time to grow. So the next one is we checked it out for ourselves. We entered the current age that you are and age you plan to retire. It was more of a retirement, but it just kind of is a visual illustration of if you put the 5123 back and get a 5% return, you'll actually have more than enough to put your 5% down on that $275,000 house. Okay, so this is something that a lot of times when you go in and get your pre-qualification, information that's not typically given up front. Of course, that's what we like to do here at Kelly, because we want to prepare you in our first meeting and not be surprised, because there's good surprises and bad surprises, and this would fall under bad surprise if you were not told up front. So during closing or for closing, you'll have your down payment. You'll also have your closing costs, which include the prepayment of taxes, interest, and insurance. Um, so, and what I always tell people, that's not something that you'll have to carry all by yourself. Down payment, maybe. You can always negotiate the seller contribute some towards your closing cost and or down payment. They can do up to a certain percentage depending on the loan program that you choose and the down payment that you put down. Typically on a conventional, if you're putting less than 10% down, the seller can give you up to 3% of the sales price towards your closing costs. And a lot of times that will totally take care of your closing costs, but the seller has to be willing to do it. Prepayment of taxes and insurance and interest. So taxes and insurance, that's for the escrow if you're going to escrow it and pay your taxes and insurance into your mortgage payment. On speaking on that, especially the taxes, when you purchase a house, depending on the month, the seller will have to give you a tax credit up to the month of closing. So like in the month of September, they're crediting you for 9 months of taxes, and you only have to come up with 4 months. So it kind of washes out. So it's nothing to be totally afraid of. Other costs that may come up would be like movers fees, utility hookups. It depends on, that's another one of those things that will pull credit. Electric companies sometimes, water companies will pull credit to see if there's a deposit or not. And then you'll want to have at least some money put back for the first year unanticipated expenses. Water heater goes out, AC goes out. Those things are likely to, or not likely, but can go out depending on the age of the house. Okay, and what are some sources of down payments? Of course, anything in your bank account, your checking account, savings account. Gifts from family, that's allowed. There just has to be a good paper trail. And when I mean paper trail, say if mom's going to give you a down payment, we'll have to source that. So mom will withdraw the money from her account, give a bank statement showing that the funds were in there prior to the withdrawal and where the funds were withdrawn. And then to your account, you'll need to show a deposit slip and where that money is now in your account with a statement. It sounds more complicated and more of a headache than it is. It's really easy to prove that, but the underwriters do like to see that. Sale of assets such as jewelry, equipment, tools, ATVs, cars, anything like that you sell and you're using that money for down payment, you have to have a bill of sale. The underwriter is going to want to see that paper trail of where that money came from. If you can't prove where that money came from, they will not count it as part of your assets for down payment, which could potentially decline you for a loan. So you'll definitely want to have that paper trail ready, bill of sale, whatever you're selling. And then retirement accounts. We caution you on that a couple of reasons. For one, if you pull out too early, you could get a penalty. A lot of retirement accounts will have circumstances where you can pull out if you're purchasing a home, and then you have to pay yourself back, which is not totally bad, but you are taken out of your retirement and potentially knocking that down at some point. So definitely want to use that as last resort if you can. So whenever we're looking at documentation for down payments, asset documentation, we need 2 months of bank statements. If there's any large unusual deposits that's not payroll, be prepared to explain where those come from and possibly provide documentation for those large deposits. That kind of goes back to like sale of jewelry and cars and things like that. That's what it's talking about. You'll need some sort of explanation and verification of where those funds came from in order to count it as part of your funds for closing. Verification of deposits, that's something that the lender orders. Earnest money, you'll need a copy of that check, and I'll get into earnest money on the second half of this. Retirement fund statement. So if you are going to use a 401k or a retirement account, you'll want to have that statement showing that those funds are there in order for the underwriter to count it as part of your assets. And then a gift letter, if a family member is going to give you a gift, you need that letter signed as far as what they're going to pay you. And the gift letter just basically says it is a gift with no expectation of repayment. So we'll need the gifter's bank statement and proof of deposit into your account, as I explained just a few minutes ago. Okay, some common misconceptions when it comes to mortgage lending. One of the misconceptions is that you need a 20% down payment if you're getting a conventional loan, and that's not true. We have 3% down conventional loans, 5% on up to however much you want to do. I recommend putting 20% down if you can, but it's not required. Another misconception is pay all your other debts first. I recommend that you don't do that until you talk to your mortgage lender, because if your debt to income seems a little high, at that point you'll pay off what you need to get your debt to income in line, but I wouldn't recommend paying off everything, because then you're just using your liquid assets that you could be using for your down payment. First-time home buyer loans are always the best because of low down payments. In certain situations, that can be good, but if you can save up a down payment, that's always encouraged, because it's better to go in with more equity than not. So put down, the most that you're comfortable with. And then last is lowest interest rate is always best. And that one's a hard one for some to grasp, but I do have a slide that kind of illustrates why that's not always the case. So I did this a few months ago, actually at the end of last year, I believe, or first of this year. So I got a conventional loan versus an FHA, which FHA is a government-backed loan, and they typically have lower interest rates than a conventional, but it's not always the best way to go. And as you look on the slide and kind of follow along with me, I'll show you why. So I did the comparison of a 30-year fixed based on a $200,000 purchase price, 3.5% down with a 740 FICO score, and financing $193,000. So on our left, under the conventional tab, we've got a rate of 3.99%. FHA has a rate of 3.375. Principal, interest, and mortgage insurance, which mortgage insurance is what protects the lender if you were to go into foreclosure. And on a conventional loan, that's required if you're putting less than 20% down. And then on FHA, it's just required no matter what. So principal interest plus the mortgage insurance is $1,000.72. Principal interest and mortgage insurance on an FHA is $1,003.67. So even though it has a lower interest rate, it still carries a higher payment per month. And that's because that mortgage insurance is so much higher on an FHA versus the conventional. And then once you gain 20% on a conventional, that mortgage insurance is eligible to be removed, and it automatically goes away once you reach 22% equity or 78% loan to value. So that just saved you an extra $80.42 a month, whereas mortgage insurance on the FHA, it remains on there for the life of the loan. So that payment will never go down. So that's why we say lowest interest rate is not always the best. So you really have to do your homework and ask your lender to explain those things. Okay, and the final C is the collateral, more specifically the condition of the house. So you definitely want to really do your research when you're buying a fixer-upper. Have an inspection for sure, because the last thing you want to do is get into a money pit, and just one thing after another goes wrong as you're trying to renovate the house. It's not really good for a first-time home buyer, in my opinion, unless you know about construction, things of that nature. But the collateral or the condition of the house is what we're going to look at. So if we're sending out an appraiser and that thing needs a lot of work, a new roof, or there's foundation issues, it's possible that the loan will get declined due to condition. So you definitely want to make sure that the house is in good repair when you buy it. So in summary of the first half, you'll want to establish good credit and pay on time. Keep your debt in good proportion to your income, which is the capacity. Save so you'll have money for a down payment and closing costs, and then pay attention to the condition of your home that you're buying. If you're having trouble paying your bills, don't ignore the creditors. You can contact CCCS for help, and the number's on the screen there and the website. And another important bullet point is don't add any new debt. Once you start the home buying process, please don't go get your credit pulled or buy a new car. Okay. So now that we've got our credit looking good, now what do we do? So now this is where we come in. You're going to meet with your lender, and this you've already pre-qualified yourself. You've gone to annual credit report, and you pulled that credit report. You've cleaned up your credit. Now we're going to pull your credit report. And there's two ways to get qualified. There's a pre-qualification, and there's a pre-approval. So a pre-qualification is basically you come in, you state your income and how much you have in the bank. We pull your credit, and we go everything based on the information that you provided. If you're getting pre-approved, you're bringing us your income, your W-2s, your assets, which would be the money that you have in the bank statements. And then we can pre-approve you based on that, which is a much stronger approval than the pre-qualification. Okay, and then once we pull your credit, then we're going to figure out which loan program is the best one for you. There's fixed rate. Fixed rate's good if that's going to be your forever home, or you're not sure if you'll ever buy again, and you plan to stay. Adjustable rates, which a lot of people are afraid of, but for people like me, I just purchased my 6th house. I'm not an investor. I don't have rental properties. Just life takes me in crazy places, and I sell every 2 to 4 years. So the adjustable rate is for people like me that will likely move in the next 5 to 7 years. And a good way to tell if that's going to be you, if you've never bought a house, if you're constantly getting new vehicles, we'll say every 2 to 3 years, just because you want something new, it could be the same way with a house. Most likely your first house is not going to be your last. You're looking for something with a low down payment. We've got programs that will do that. Home improvement, purchase rehab. Those are getting more limited these days as far as who offers something like that. The credit union does offer a purchase rehab. You'll have to get a contractor involved. You'll need to get bids and all that stuff prior to us closing, though. So you'll definitely want to talk to your lender if that's the direction you're looking at going. And then a conventional conforming loan, which is what we call, you may have or may not have heard the terms Fannie Mae or Freddie Mac. They're the ones that offer the conventional. Conforming means it conforms to their guidelines and rules, and you don't stray outside their box. Conventional non-conforming is going to be more of a portfolio type loan, which here at the credit union, that's what we offer. And we can do some non-conforming things, which means it doesn't conform to what we call the secondary market requires. Or there's government loans, which is FHA, USDA, and VA loans. Now comes the fun part. You get to pick a house. So are you looking for a new or existing home? A detached single family, which is just your standard home that's not like a duplex or something like that. A manufactured home, which you're going to limit the lenders on that. Not very many lenders are doing manufactured housing these days. We do single wide and double wide, because typically if you find a lender that will do a manufactured home, they're limited to double wide. and it has to be a certain age. It can't go beyond a certain age. Condominiums, again, there's some stipulations with some lenders on condominiums. It has to meet certain requirements as far as occupancy, rental occupancy versus owner occupied, that sort of thing. And then a cooperative, which that would be very, very rare in East Texas. I don't know that there are any, which basically it's owners who own shares in corporations rather than the units themselves. So it's not really anything that's owned. And that would be extremely hard to find financing for. And another thing that you want to look at is it unique? Just because you like it doesn't mean that it'd be easy to lend on. So when I say unique, a unique property would be like a barn-dominium, even a log home will fall under that in most cases, a geodesic dome house. So what makes those properties unique is there's not very many on the market. So if an appraiser can't find a comparable for it when they're appraising and getting the value of your property, most lenders, if there's not a like house, so if the appraiser is not comparing a barn dominium with a barn dominium, most likely they will decline that. At the credit union here at Kelly, that is something that we can work with. So we have a broad range of what we can do versus what others can't do. Okay, and this is another important one, the location of the house. So decide what's most important to you about the neighborhood that you want to live in. Do you want to live closest to your kid's school, or do you want to be in a certain school district? Do you want to be close to work? Which in the last 6 months, the close to work thing has kind of changed a little bit because a lot of us have been able to work remotely from home. So that may or may not apply anymore. Do you want to be close to town with grocery stores, entertainment, that sort of things? Do you want to be close to relatives? Do you want to be far away from relatives for some of us? Close to public transportation. So those are all the things that you want to take in consideration when you're looking for a house. So ways to find a house. Web searches are pretty popular. Zillow, I personally use a lot. I just like to look on Zillow for just market research for myself. Realtor.com, Trulia.com, even Facebook has some the marketplace where you can go search houses, or there are little Facebook groups for houses for sale. Open houses, and actually Zillow, you can go on Zillow and filter that and search only houses that are hosting open houses. Home shopping guides, you don't see that much anymore, but actually a realtor dropped some off here at the office not that long ago. So they still do print them, but they're few and far between. Neighborhood drives. I just bought a house back in June, and I cruised through a neighborhood that I've always liked and happened to find a house that was not advertised or listed or anything like that. So that's a good way to find a house. The best way to find a house, though, is to find a real estate agent. They have access to the MLS, which is the multiple listing service, and a lot of those houses they can find may not be on Zillow or Realtor.com, so they have access to things that you couldn't find yourself. So why use an agent? They can provide the printouts of houses that meet your specs. So you definitely want to tell them what you're looking for, and they can specifically tailor that house search to exactly what you're asking for. They may be able to help you see the big picture. So if you go into a house you don't like the color, or you don't like the way they've arranged the furniture, they may have a better vision than somebody like me that can't see those types of things and need a realtor to kind of help me along in that area. They can provide, more local information on the shopping, the schools, the tax rates if you're moving into a new area that you're not familiar with. They can help you negotiate and present your offer to a seller, and that's something that's very important, especially if you're first-time home buyer, you've never negotiated that. It could be an intimidating thing, and that's where a real estate agent, that's their strong suit, is the negotiation part, and helping you feel comfortable and giving advice on reasonable offers that won't offend your sellers. I've had a buyer offer me way lower on a house that I was selling a few years ago, and it did offend me, and I didn't want to deal with them anymore because of the offensive offer. So you definitely want to keep in mind that you don't want to just throw a really low offer out there because they may not want to deal with you at all after that, and you could potentially lose the house that you really, really like. And another important aspect of the real estate agent is they represent your interest in the transaction. So whenever you are looking for a house, I recommend that you don't call the listing agent on the house that you want to look at. Go find your own agent, interview them like, because they're working for you. So you'll want to interview an agent and, see what they're going to do for you. So if you're calling the listing agent, that listing agent works for the seller and won't necessarily have your best interest in mind, as if you were to go get an agent for yourself to help you out, because you're not going to pay the real estate agent 9 times out of 10. The seller is, and you'll know if you have to pay the agent. It'll have to be negotiated that way, but that rarely ever happens. So go get your own agent. Okay, and these are some house hunting tips. So whenever you're looking at houses, most likely you're going to look at a lot. So take pictures inside and outside of the house. Bring someone with you that will ask a lot of questions, like a spouse, boyfriend, girlfriend, family member, or friend. Find something that fits within your budget. Make sure that the housing costs fit in your budget. Think about regular maintenance items. The AC, filters. You'll have to buy a lawnmower if you don't already have one, and the gas it takes to run a lawnmower every year. Ask about the average utility cost over the past year, and make sure you get costs for all seasons. That way you'll kind of know what to expect on your electricity bill and your water bill each month. And think about does it have reasonable commuting costs and time? So, gas getting back and forth to work, and the farther away from work you are, you have to take in consideration your vehicle maintenance, oil, tires, that sort of thing. And take your time. There's no rush on this. Well, in a sense, the market's pretty hot right now. The houses don't last too long, so you don't want to take too much time. More tips on house hunting. Don't rely on your memory. You'll probably be looking at so many houses that it'll all kind of blend and blur together. So take notes, what you like, what you don't like. Use a checklist. You can actually get these online just by Google searching a home buyer's checklist, and there's even apps for your smartphone that you can download, a little checklist. Review your notes, prioritize which ones are your top, and throw out the ones that you don't want, and ask for a return visit before you make an offer. And I had somebody tell me one time that what they did was they looked at a house, they went there in the morning, they went there at lunchtime, they went there in the evening, just to kind of see how the neighborhood was at different parts of the day. So that's a good tip on that. Okay, so now you've found the house that you like. You want to make a reasonable offer. Decide who pays for what. Typically, your seller is going to pay for the title insurance. They may even provide a credit towards your closing costs. So you'll want to negotiate that and get that in the contract. They may purchase a home warranty for you. And if you want to see if there is a survey. If there's not a survey, you'll need to determine who's going to pay for that. Either the buyer is going to have to pay for the survey, or the seller, if there's not one existing. And then earnest money. So as the buyer, what the earnest money is, it's a good faith payment that shows shows the seller that you're serious about purchasing the house. $500 is probably the least that I've seen. They're more commonly at about $1,000 to $1,500, depending on the price of the house. So that gets credited at the end towards your closing. So that's not a lost payment. It actually goes toward the closing as long as you close. And you want to see if this is not your first home, are there any contingencies? So if you're trying to get out of a home, but you're making an offer, you make sure that you disclose that up front, that this is a contingent contract on contingent on you selling your house, or contingent on you getting approved for a 401k withdrawal, or gift funds. Negotiate counter offers. So that's where that real estate agent is really helpful, because they can help you, go back and forth between the seller, kind of be the mediator between you and the seller, or the liaison rather, to negotiate that for you until you come into an agreement. Are you using an agent? That would go back up to highly recommend. If you're not, you have to negotiate directly with the seller. If you have a real estate agent, then I don't see it's necessary that you have an attorney review the sales contract. If you're doing it, for sale by owner, and you're going directly to the seller, it may not be a bad idea to have an attorney, a real estate attorney, review that contract for you. And then lastly, get an inspection. It's not required, but it's highly recommended. That way you don't, there's no surprises there. So let's talk about inspectors, what their job is. So it's not the inspector's job to appraise the value of the house, but to do a visual exam of the structure and the systems and tell you whether or not the house is in sound condition or if it's in bad repair. They're going to be looking for water damage, maybe that you can't see as you walk in, foundation issues. The biggest telltale signs, if you're not seasoned in doing that, is if it's a brick house, you'll see cracks in the mortar on the outside, or maybe on the sheetrock, on the inside. They'll also check out your electrical system and your plumbing to make sure that's all in good working condition. So an inspector is good, so you know what you're buying, and that you won't be surprised after closing, because once it's closed, that would be your problem and not the seller's. Okay, so once you've got that the house that you want, now go back to your lender. You'll want to provide the lender with the signed contract as soon as you can get it to them. That would be best. That way they can go ahead and get working on it and help you meet your closing deadline. Provide your lender with your income documents, tax returns, W-2s, however that goes. 1 month of paycheck stubs, 2 months of bank statements. That way they can determine your cash to close, or verify your cash to close rather. And then once you get all that to them, your lender is going to prepare the disclosures, and you can either sign them in the office, paper copies, or a lot of times what we do is electronic signatures through DocuSign, which just makes the process that much quicker. Your lender will have to have a copy of the survey if there's not one existing on a purchase. I don't know any lenders that will let you get away with not having a survey, because the lender is going to want to know that that house is situated correctly on the property and it doesn't encroach on any property lines. Your lender will order your title commitment from the title company that either the buyer or the seller chooses, and then the buyer will pay for an appraisal and the lender will get that ordered for you. Okay. I know this looks like a lot of information. I'll explain it. In 2015, the Consumer Financial Protection Bureau, or the CFPB, made it to where lenders are required to get the buyers a copy of their closing disclosures at least 3 days prior to closing. So this is just kind of a guide of when you can close. So if we electronically deliver or hand deliver your closing disclosure, which you'll get your your closing disclosure once your loan's been cleared to close from the underwriter, and you've got a closing date already set. So if your closing date is on a Monday, you'll have to have that closing disclosure at least by the previous Thursday. If you're by mail, it requires 7 days, and it will have to be mailed out that preceding Monday. Same for Tuesday, the preceding Friday, Wednesday, preceding Saturday. So it kind of goes on. So just keep in mind 3 business days prior because most everybody has an email address, and 9 times out of 10, we're delivering that electronically versus in office, or certainly not by mail. Okay, we have made it to closing day. Your primary responsibility on closing day is you'll make it to the title company. You'll have all the lender's documents to review and sign at that time, and then that's where when you'll pay all your closing costs with the certified check made out to the title company. Make sure you keep a copy of every document that you sign. A lot of times the title companies are either putting them on a flash drive or on a disk, either in place of paper documents or in conjunction with paper documents. And just make sure you keep that paperwork in a safe place. And the reason why you want to keep those documents is if you were to refinance, you'll have things like your survey ready for the next lender that's going to refinance. And also within 7 years of initial finance, if you refinance within that time frame, you'll get a credit towards your title policy. So you'll want to surrender that old policy to get that credit. Okay, now to summarize the home buying process. So you'll want to pre-qualify yourself, which is what we talked about in the first half of the presentation. And then around that same time, you'll want to shop for a loan officer as well as a real estate agent. Get yourself pre-approved. Then once you're pre-approved, because most realtors don't want to show you any properties unless you give them a pre-qualification or a pre-approval letter. Then at that point, you can search for homes, get your agent to schedule some showings for you, and then write the offer and negotiate the contract. Once you get the contract signed and what we call executed, then you'll need to get that to your lender, your loan officer, for the preliminary processing. Once it goes through processing, then it goes to the underwriter, who will look at it and make sure all the documentation is good and correct and there's nothing additional needed. And I will tell you that there's always going to be some sort of condition that comes back. I've never had a perfect file with that where I didn't have any conditions back. That's just kind of the nature of the beast. So don't get discouraged if your lender or loan officer calls you and say, hey, we need this document. That's going to be completely normal. Once it goes through, once you gather condition, which will be the final processing, then it goes back to final underwriting for approval, and then pre-funding, which is the lender and the title company are now talking, getting all their final numbers done and funding set up. And then prior to closing, you'll want to do a final walkthrough, which your real estate agent will schedule with you. That's usually done either the day before or even the morning of closing, just to make sure that when the seller moved out, there's no major damage or anything like that needs to be addressed prior to you signing documents, because once you sign the documents, that house is yours and no longer the responsibility of the seller. Then after you do your walkthrough, you are at the closing table signing documents. And I think we are ready. So, and I don't know if anyone has questions or if y'all been asking questions. I've just been flying through this this presentation, looking at slides. We do appreciate it that you guys joined us. And if you have any questions that you want to come in the office, me or Audrey are here Monday through Friday from 8:30 to 4:30. We're available by phone or in person, so we'd be happy to sit down with anyone and just go over some options and get that pre-approval or pre-qualification.